Good afternoon, everybody, and welcome to this edition of Hardman Talks. My name is Mark Thomas, and I'm the analyst here at Hardman & Co. that covers the Appreciate Group. I'm delighted today to be joined by Ian O'Doherty, the Chief Executive, and Tim Clancy, the Chief Financial Officer. They will be doing a short presentation on the business, which I think it's fair to say has been through a massive transformation in the past few years. Without more ado, over to our speakers.
Thank you, Mark, and good afternoon, everybody. I'm delighted to be here and be able to talk to you a bit about Appreciate Group. Thank you for your time this afternoon. So I'm Ian O'Doherty. I'm the Chief Executive of Appreciate Group. I'm joined by my colleague, Tim Clancy, our Chief Financial Officer. So for those of you not familiar with Appreciate Group, we provide many of the UK's most popular gifting, prepayment, and engagement solutions. I'd like to start by playing a short video that'll provide a simple overview of our business.
Our products create joyful moments for customers, whether celebrating, rewarding, or prepaying for future events. We do all this through a prepaid financial product that can be loaded with value when purchased, which can be accepted in person or online at over 150 brands, including food, hospitality, leisure, entertainment, and leading retailers. We offer a choice of formats: card, paper, or digital. We serve different audiences. Businesses, through engagement, we help corporate clients reward their staff or incentivize customers. Consumers, gifting helps people gift for occasions for everything from birthdays to weddings. Christmas savers, prepayment helps customers prepay for events such as Christmas, which is where it all started for us. At the heart of all this is Love to Shop, the name for our exclusive prepaid financial product.
I hope you found that a useful overview. Let me provide a little bit more detail about the core areas of our business. As mentioned in the video, we have a core product and it's used by different audiences, different market segments for their purposes. So let me just talk a little bit more about each of those. First, starting on the left-hand side of the slide, as you see it, the engagement area. So this is really our B2B arm. So this is where we provide businesses with our product to help them with their incentives to customers or engagement with their clients or employees. As you can see there, billings to just over 200 million. That was the year-end number last year. We've got about 42,000 clients that are making use of our products. It's principally relationship managed in the sense that we talk to our clients, engage with them and understand what their needs are and try and address those with them. We do also provide the possibility and the option of the clients working directly, so purchasing directly from us for the needs that they have. It's an area of focus for us. We see opportunity. I'll come to a little bit about the market size in a moment, but we've got a share just over 6%, and we see it as an opportunity, and we'll continue to put a lot of attention towards it. In the middle, we talk a little bit about gifting. So basically, some customers use our product for their gifting needs. So this will be right throughout the year for various birthdays, Mother's Day, whatever it might be. This is a very big portion of the market, but we have historically not played a lot in this space, so we don't have a large share at the moment. We offer the opportunity to purchase online at our own website called highstreetvouchers.com, but we've also recently provided a physical distribution option for clients, so people can purchase our products, a digital version of our product, but at a physical location, anywhere that PayPoint is provided. So pretty much throughout the country at all the various outlets that PayPoint have, you can go in and purchase one of our products. And then finally, on the right hand side, we talk about prepayment. This is where customers use our product as a means to basically sort of save and regulate their savings with a target in mind. It's primarily for Christmas, so we talk about Park Christmas savings. It's where the business began many years ago, but it's where people put aside money over the course of the year to have funds for their Christmas shopping, and then they use our product for that shopping. In terms of the size, we are dealing at any given time with close to 300,000 families that are saving with us. We've got a network of agents across the country, about 30,000 agents, but we also have clients that come to us directly. So people who come directly through us, or people who go through an agent. It depends, and we're quite happy to work with either. We are the dominant party in this particular market, so we have a large share. As you can see there, 71%. And underpinning all of this is Love to Shop, the various formats of Love to Shop, but it's the Love to Shop brand and the prepaid instrument that we talked about in the video. So when we think about our strategy, so Tim and I joined the business back in 2018, and we introduced a strategy that was all about driving transformation in our business. It was a business that was desperately in need of modernizing following years of underinvestment, and we set out to deliver, as it says there, a more robust and scalable platform. So basically, we recognized that the business needed to have a much more robust platform on which we could operate. And so we focused on 4 key areas. We talked about productivity, appeal, clarity, and experience. And we worked on each of these in terms of trying to improve them and deliver, as I say, a more robust and scalable platform. At this point, we're evolving our focus. That the whole point of having a more robust and scalable platform was to be able to drive growth. We've done a lot of the heavy lifting to get ourselves to where we're more comfortable with the platform. And sorry, I should say by platform, I mean the entire business, not simply the technology elements of it. But we're more confident in the platform at this stage, and we really now want to focus on driving growth through that platform. And we're looking at 4 key areas as we do so. We're talking about performance within the business, and the products that we offer, making sure that they're all products that are needed by our customers and valued by our customers. Working with our partners, we want to not just be able to sell to our partners, but actually have strong relationships and multi-dimensional partnerships where possible. And then the platform continues to be something that we need to invest in. The reason for the significant transformation was, as I mentioned, because of historic underinvestment. So we don't want to fall into that situation again. So we want to make sure that we maintain the platform. Again, the technology is a piece of that, but it's the entire business and how all the pieces work together. We want to make sure that we continue to invest in that so that it is fit for purpose and it maintains its sense of being robust and scalable for future, not just for now. So this slide just talks a little bit about how we are building a business that's fit for the future, and just tries to demonstrate some of the progress that we've made over these years in terms of that strategic journey. So I'll just focus a little bit on a couple of areas here, but infrastructure investment, this was something that needed a lot of work. We've modernized our technology. It's now much more resilient in terms of being able to cope with volumes of traffic coming into our websites and using our products. And we've also improved the security within that. One of the key things when you're working with a network, like a payment network like ours, is making sure that it's secure and resilient so that customers feel confident in it. And we've done a lot to ensure that that is the case. We're also using cloud where it's appropriate. So we're making good strides in terms of building sensible use of cloud technology to support our business as we move forward. And then we have just recently implemented a new ERP solution. It was a very large project, a very large piece of work for us. We were historically working off technology that was well over 30 years old in places, and very difficult to maintain and very difficult to adapt for the business as the business evolved. So we've replaced it, and we now use a more up-to-date platform for that, and we'll continue to build on that and enhance that. But the core, the spine of the business in terms of the ERP is now much more fit for purpose and indeed fit for future. We've also transformed our workplace culture. We needed a lot of work to do to ensure that we had a much more collaborative workspace. It is very much our philosophy that, you know, working together we can be more effective, and we want to ensure that we are effective, because effectiveness is really the ultimate efficiency in what you do. And we've done a lot to ensure that the workplace and the practices within the workplace are collaborative and supporting what we're trying to do as we move forward. A key part of that is making sure that our workplace is a place that people enjoy working in. You know, it's hard work, don't get me wrong, but at least we want to make sure that people want to work there and feel good about themselves working there. And so we participate in the Great Place to Work survey program, and we're pleased that for the last 2 years, our first 2 years in the program, we have been certified as a great place to work, and it continues to give us opportunities to you know, see ways of improving our workplace and therefore improving our effectiveness within the workplace. We've done a lot to modernize the workplace practices, streamline our workflows, and all of this has added up to us being able to attract better talent as well. We're much more competitive for the kind of skills that we need as the business going forward, and it all sort of hinges around having that workplace culture that's appealing to people, but also an effective way of delivering for our business. And then lastly on this slide, just talk a little bit about digital first. So we have very much been evolving as a business. It started off, as I mentioned, in Christmas savings, back when it was just paying through agents, and then there was, you know, paper vouchers were involved, and then electronic payments, and now it's digital. And, you know, we still have the various formats, but we are very much focused on ensuring that we are digital and use digital in an appropriate way and can build on that for the future. Last year, we launched a contactless digital gift card. This is a product where you can actually purchase online, deliver it digitally to whoever you're giving it to. They can receive it digitally, load it into their phone, and then use it in a contactless point of sale somewhere, wherever they choose to use it. So the whole end-to-end purchase, delivery, and use is a digital one. And you know, very much a way forward. We still have the other physical formats as well, but digital continues to be a key focus. Our billings are growing fast, and our redemptions are also increasing, and we're giving digital friendly choices in terms of where you can use our products. Mention a few there, like Just Eat, Xbox, Spotify, but you know, that whole sense of being able to, you know, order online and so on, we need to be part of that, and we continue to enhance our product to make sure that we are. The solutions that we offer, as I mentioned, are many formatted, but at its core, it's the same sense of a prepaid gifting product. But there's a excuse me, a gift card. We have our own proprietary network called FlexiCash. We also use MasterCard network. We've got an e-gift card that's available, and we've got paper vouchers. We do also, where necessary, provide single-use cards through our partners, and single-use e-gift cards also. And we have an open loop MasterCard that we make available to our Christmas savers, which is a popular item with them. And occasionally we'll do special projects for partners. One of them was a very significant one that we did with Iceland last year and the year before, where we provided essentially a white labeling of the gift card for their particular purpose of being part of the government free lunches scheme. So as you heard mentioned in the previous in the video, and I mentioned also, underpinning all of this is our brand, the Love to Shop brand. We have a very high level of brand recognition that we want to make sure we can take advantage of. There are millions of recipients every year exposed to our brand, and it's something that we need to continue to protect, but also build upon. Love to Shop is a multi-redemption product, and it's something that we see as an advantage. It means that people have different choices as to where they might use the product. It's not simply focused on one particular outlet, one particular retailer or whatever. So the multi-redemption is a key element of our business. It also gives you a certain level of protection. So sadly, over the last number of years, you will have seen certain retailers you know, not continuing going out of business or whatever. So if somebody had a gift card with that particular retailer and it was only for that retailer, they may well have lost their money from that product. But with ours, if that were the case, the retailer goes out of business, well, you still have many, many other retailers or other outlets that you could use our product at. So you've got protection in that sense. And we do, of course, have protection in the sense of the monies that are loaded onto our products are held in trust and safeguarded on behalf of the consumer. So there's protection in the options as to where you can spend, but also protection in the real sense of the money being held in trust and being safeguarded on your behalf. Looking quickly then at our competition, we have competition from a number of different angles. We have retailers who offer their single store use cards to businesses, so compete directly with us on the B2B side. And indeed, some of those retailers are also partners of ours, so it's a little bit incestuous at times, but sometimes we'll have a partner who's like M&S and Argos, and indeed John Lewis, they're all partners of ours, but they will also compete with us in terms of some B2B business at times. We do have other multi-redemption offerings that are in the marketplace competing directly with us. The one you might be most familiar with is One for All. It's the one that's most closely aligned to our product. And then we have intermediaries, people that are selling various gift cards, including our own, that are competing with us for the business that's out there. Looking then briefly at the market and the opportunity for growth within it. This is a depiction of the gift card and voucher market in the UK. The data shown here is from 2019, so a little bit out of date. The data has not been updated recently. We hope it will be in the next few months, but for now it's still good indication. Obviously it's pre-COVID, but it's still a good indication of the general size and scale of the market, and indeed some of the trends in it. So you'll see there that there's about £7 billion spent in the UK each year on gift cards and vouchers. It's divided at the almost equally between corporate and consumer. If I look on the corporate side, you can see there that there are kind of three main areas within the corporate side. There are incentives, so where businesses want to use a product like ours to be able to incentivize their customers. An example of that would be, we have a current contract with Sun Life, so they give a gift card as a welcome gift when you take a policy with them, and they use our product to fulfill that gift. Employee benefits is another key area. So some employers like to use our product or a product like ours to be able to give an employee the benefit of being able to basically get subsidized cash. So they can use our product. You can load a certain value onto the card, and the employee is able to load, let's say, £100 of value for maybe £95, and the employer will pay the difference or negotiate with us in terms of how they will handle getting that difference paid. But it's an employee benefit. And then there's also staff rewards. This is where an employer wants to reward their staff in some sense, like an employee of the month program or top salesperson, that sort of thing. You can see there the market share in each of those. We're probably in the sort of around about the 5 or 6% overall in the corporate space, but lots of room to grow also. On the consumer side, there's two sections: Christmas savings and then other consumer, other spending. So the Christmas savings, I mentioned, we're the largest player. There's one other player that's close to us, but and then there's some smaller ones. But we've been in that market the longest and have a sizable share, as you can see. And then on the other gifting side of things, you've got 3.4 billion, it says there, so a substantial amount of spend. It's quite fragmented. We haven't historically played in there, and it's also a difficult enough market. So we are realistic about our opportunities in there, albeit we're still making the effort to try and make inroads into that, because as you can see, it's quite a substantial market. So again, these numbers are pre-COVID, but they give you a good sense of the shape of the market. And the pre-COVID expectation was that the market was going to continue to grow, in particular on the corporate side. The general consensus is that is going to happen. It's just been delayed a little bit by the years of COVID. So that's a quick overview of our business. I'll hand you over to Tim, who'll talk to you a little bit about our financials.
Okay, so on the slide there, you can see our three primary financial measures. If we go through them all in turn. So billings represents the gross value of all our product. So if it's a gift voucher, a gift card, or indeed a digital product, it represents that value. So if it's a £100 voucher or £100 digital product, it still represents £100 in billings. And indeed, in the past, when we were dispatching physical products, such as hampers as an example, that would also appear gross in billings. So you can see there steadily over £400 million of billings for a £400 million business, a slight dip down during the COVID period, and a range of somewhere approaching 400 million again for the financial year that we're in today. On the right-hand side, you can see revenue. Revenue is calculated based on accounting rules and can vary by type of product, but essentially represents both the service fee that we earn from our redemption partners, plus the elements of non-redemption income, which we earn when unspent balances expire. So again, steadily over 100 million of revenue, and again, the net value, the net commission for most of our products. Where we do buy in a small quantity of third-party products, then they would appear gross in revenue. So £400 million of billings and just over £100 million of revenue that's represented from the service fee and non-redemption income. And then finally, PBT. So prior to the pandemic, the business was, as you can see there, generating over 11 to 12 million pounds of pre-tax profit. Obviously took a dip last year in the year ended March 21, heavily impacted by COVID and our ability to dispatch products and lower demand in the first part of the year. But you can see there again, looking at the analyst range for this year, a steady improvement back, and we'd hope to get much closer to historical levels in the next year as well. One final point on profit. Two of our main income streams appear in revenue, i.e. service fee and non-redemption income. Pre-tax profit also accounts for historically quite a high level of interest income. So in historic years, about £1.5 million of profit driven by the interest income that we earn from the large cash balances we hold, both our own free cash balances, but also the cash which is safeguarded on behalf of customers. And as interest rates look like they're possibly going to increase again, then we'd expect to increase that level of interest income in the future years. So as you've heard, two main segments of the business. Firstly, the corporate part of the business, B2B business, over 40,000 clients, about half the business, so about £200 million of billings, about 1,000 clients are account managed and, speak to people and are sort of monitored. The vast majority of those 40,000 clients come through either self-service portals or indeed through our website highstreetvouchers.com and serve themselves, and are quite high margin because they're not negotiating discounts. So £200 million on our corporate business equates to just over £50 million of revenue, and again that represents largely the service fee and non-redemption income. On the consumer side, the two parts of that business, the Christmas savers part, which is the vast majority of the billings, and then high street vouchers, which is our gifting business, so ad hoc purchases coming through and buying gifts, much lower transaction value, but you've seen from the market share slide, a real big opportunity to grow in that area. And again, a very, very similar level of revenue coming from that segment of the business. So how's our trading fared over the last few quarters? So this chart tries to answer that question. The top box shows our billings, our primary indicator, against last year. Last year was, of course, COVID impacted. So like many businesses, we're showing the year before as well. So perhaps I'll talk about billings versus the year before, the financial year 2020. So we saw a slow start this quarter. So in the first quarter of this year, I think a lot of the feedback we got from particularly our corporate clients was a lot of people trying to focus on getting back into the office last sort of spring, summertime, and getting back to normal following that sort of third lockdown. Then we had quite a strong Q2, plus 14% on prior year. So we saw a bit of a bounce back and a bit of timing adjustment from Q1 into Q2. And then Q3, which is a really important quarter for us, the quarter running up to Christmas. We have strong demand from our corporate clients who are both rewarding employees more during that quarter leading up to Christmas, but also trying to attract more customers and using our customer incentives more during Q3. So a crucial period for us, and that was plus 13. So we were delighted with the pre-Christmas period. If you look at the box above that, it was broadly in line, -1% on the prior year, and we really felt that the prior year there was a lot of business we wouldn't normally expect to get from a lot of businesses cancelling Christmas parties and giving our rewards as an alternative, and we didn't think we'd keep all that, but we actually produced a really strong quarter in Q3 last year and did really well. So cumulatively about 8% ahead of last year as we come into, we're partway through the final quarter now, which is much lower than Q3. In outlook, as you've seen from the performance indicators, our profit is predicted to be much greater this year than last year, and the analyst views are that that will grow again next year as we come out of the pandemic. We've done a lot of work over the last year or so simplifying the business. We closed down our hamper packing business, we've relocated the site, we've closed some subsidiaries or sold subsidiaries, and really simplify the business to allow us to focus on the core offering. From a cash point of view, we are forecasting positive free cash for the rest of this year, in fact the rest of this calendar year as well. We do have a facility which allows us to grow. We don't see ourselves needing to use that facility during the rest of 2022, but that is there if the growth comes in much higher than we're predicting. And those very encouraging trends we've seen across Q2 and particularly Q3, I think give us confidence that we will hit those growth forecasts which people have for the next 2 years. So that's a very quick run through the financials.
So I guess just to summarize then, we've done a lot of the heavy lifting in restructuring and simplifying the business, and the benefits are now starting to come through. Our platform is definitely more robust and scalable, so we're more reliable, and we feel that it's in a state where we can put more business through it and drive growth opportunities. So the evolution of our business is really from fixing the platform to leveraging that platform to drive the growth in our business. So thanks for your attention. We're happy to answer questions, so I'll hand it back to Mark.
Thank you both, very interesting. Perhaps we'll kick off with a couple of corporate governance. First of all, while the company has been digitally upgraded, do you feel the board's expertise needs to be digitally upgraded too? It appears very strong on corporate governance, but perhaps digitally light compared to the growth of the business. So question around the board skill base.
Yeah, so Mark, I think the short answer to the question is yes, we want to evolve the skills base of the board in the same way as the business is evolving. So yes, we're in the process of recruiting for a new chair, as people will probably know, and that's definitely a factor in our thinking. I do think it's important to point out the importance of governance and the part of the evolution of our business is such that we've even in the short time Tim and I have been involved, that the regulated half of or rather portion of the business has gone from probably roughly a quarter of the billings to 3/4 of the billings, and indeed regulation has increased as well. So governance is still very important, so we wouldn't be wanting to dismiss that. But yeah, the point is valid, and we want to continue to evolve the skills and experiences around the board table to fit with the business as we go forward.
A bit of a curious egg in this one on the governance. Why did the directors hold so few shares in the company? I am considering an investment, but I'm reluctant when that would be more than anyone bar you, Ian.
Yeah, I think a lot of businesses look at that as a metric, or sorry, a lot of investors look at that as a metric for other businesses, and that's fair enough. A lot of businesses have programs whereby every year the executives are being rewarded in shares, and then the executives are presumed to be keeping those shares as they go along. We have not had that program in place, or a program of that nature in place. So it's not a direct and fair comparison with other businesses where you might look at the shareholding of the executive management, executive board members in those businesses. So I wouldn't be misled by that comparison, is what I would say.
Right. You made quite a few comments about the investments which have been made to transform the business.
Yeah.
What is the outlook for capital expenditure going forward, given that heavy investment that you've made in the past couple of years?
Yeah, I'll take that one, Mark. So we have, done some heavy lifting and things. We said in the presentation over the last sort of few years, about 5 million investment in intangibles last year. So big numbers. Big chunk of that has been our ERP system, which we've launched the first part of that in January. That is the platform, as we say. We do think there will be further investment required to digitally enable customer journeys and further digital products, but I wouldn't say it's at that level. So yes, we aim to still invest and still be ahead of the game, ahead of the competition, but not at the levels we've seen over the last couple of years.
Brilliant. And this one is definitely one for Tim. So that I can better understand the business, can you explain the high trade payables and the high provisions in the half-year figures?
Yeah, I mean, we have we hold a lot of cash on the balance sheet, and a lot of that is cash in advance. It represents cash in advance or cash in trusts, which we hold. So look at it as the other side of the entry from that, really. Obviously on the cash is safeguarded, as we say. We've got two main areas: Christmas savers, where we have a voluntary trust where we'll hold that cash as cash in trust, and the other side of the entry will be monies in advance, which is in that point you're referring to. And then secondly, we'll have cash in our e-monies trust, representing either monies owed to end users, or monies owed to redemption partners. So it purely reflects the cycle of the business, with a lot of activity at the end of September, just ahead of the peak Q3 period.
So perfectly normal nature of the business. Couple of divvy questions here, sort of the same area. What is your dividend policy, for example, in terms of cover? And can you confirm your dividend policy is now you've returned to making dividend payments? So basically a dividend policy.
I'll take that one again. I mean, our dividend cover works out about 1.8. So we distribute just over half of our net profit after tax as a dividend. At the start of the pandemic, like many businesses, we suspended our dividend policy while we were all trying to work out what the world what was happening in the world. We have returned now, so I think November year before last, we returned to the previous policy, and that's in place. So back to normal on the dividend policy, and dividend payments continue.
Brilliant. Does management see a risk of declining revenue from the switch to customers using more e-gift vouchers? In particular, why would someone choose, for example, to buy a Boohoo e-gift voucher from Love to Shop rather than from Boohoo directly? So
the reason why we would hope that somebody would make that choice is that they would get greater choice from doing so. So if you were to buy a Love to Shop e-gift card in the way you describe, you would get access to Boohoo. So you'd be able to spend your money at Boohoo, but you would also be able to spend your money at 50 plus other places. So if either you or whoever you gave the gift card to had a change in heart, if you like, and decide, oh, maybe I don't want to buy something from Boohoo, you'd have like Fat Face, ASOS, New Look as options. Or if you totally got it wrong and gave it to somebody who had no interest in buying fashion or whatever, B&Q, Halfords, you could go spend it for Spotify, Xbox. So your variety is, there's a whole range of options. So the answer is the flexibility that it gives you is the benefit. We want you to buy the Love to Shop rather than buy directly from the retailer in question. You said Boohoo, but any of them. We'd rather you buy from us and then have access to all those options.
As an uncle whose niece's birthday was yesterday, I can very much relate to that, I have to say.
Well, there you go.
There was a question sort of on competition again. I think you partly covered it. Who were your main competitors in B2B and high street vouchers? But the supplemental was, what were their approximate market shares? So where you had that slide, can you just sort of give a sense as to the scale of the main competitors?
Yeah, unfortunately, we don't have that. The market data is not such that we can do that. It'd be guesswork, and even then it'd be very limited guesswork. So I'm afraid I'd love to know that, but I don't have that. So.
Okay, and then on a slightly different angle, how would you compete against the Amazons of this, sort of the Amazon vouchers?
Yeah, well, I mean, obviously Amazon is something that, an outfit that the people use a lot and is very well regarded. Some retailers don't want to be associated with Amazon, so they're very happy to come to us. And some customers aren't so keen on it either. So we provide an alternative. We provide choice, again, a very broad choice. So I think we are competing successfully, but on clearly a smaller scale than Amazon.
Please, could you go into some detail about the free school meals offering? Is there some relationship with Edenred? Is it for periods when schools were closed for COVID and holidays? Will revenue now tail off or suddenly stop? Was it profitable?
Yeah, so a few questions in there. Well, yes, it was profitable. We were happy to get it and have the chance to be part of it. The free school meals program is indeed, it was a government-led scheme, or is a government-led scheme where funds are made available to families that need them to purchase the school meals for the pupils, right? When COVID hit, the program went digital and was being delivered digitally, so that the funds were still being delivered and made available, just kids weren't in the schools, right? So we have a long-standing partnership with Iceland, and Iceland were not able to be part of the digital version of free school meals when it happened just at the beginning of COVID. And so basically what would happen is it was Edenred was acting on behalf of the government and providing codes to the schools to give out, and then those codes could be redeemed at the outlet of choice for the family, right? And Iceland was not one of those choices at the very start. Iceland turned to us and said, how can you help us be part of that so that our name is on the list, so that a family can choose to spend their money with us? And so we were able to, like I mentioned earlier, kind of white label our technology to allow them to use and to be an option. So the family would get the code and then be presented with a range of options, of which one was now Iceland. And then those families would choose to go and spend it at Iceland, and Iceland got the business, and well, we were part of that, and counted in our billings. So for the period when the program was working in that fashion, we were supporting Iceland. That partnership, that aspect of the partnership is ending. The program is also ending in the fashion. It'll revert to the old way as soon as schools are back to normal, which I hope they are by now. So that was what I hope that explains what we were doing, and we were very pleased to be able to help Iceland because they're, as I said, a long-standing partner. It was very important for us. It was good for billings, but it's also good that we were able to help them be part of such an important program.
And as you say, it was profitable.
Yes.
We've had a couple of questions around Christmas savings. I mean, I suspect you're going to answer it in the way your advert for Park Savings begins, but I mean, your trading statement said you provide an update in April. I mean, can you say anything about Christmas savings reinvigoration at this stage?
Not in terms of how the program for this year is going, the one for Christmas 2022. We're in the middle of the acquisition phase, if you like, the marketing promotion of it, but we aren't able to give any indication of how it's going until we get to the end of March, and our early April trading statement will give a sense of that. It's just that it's premature.
Could you just elaborate a little bit more on where you actually make the money? So effectively, who you are charging? Is it the retailer discounts? Where does the money actually come from?
Yeah, I mean, I think if you go back to the, remember the financial slide in the presentation, the revenue number is made up of two aspects. Firstly, it's the service fee. So when a customer buys our product, they go and spend it. They spend it in a redemption partner for which we have a commercial contract with, and we'll earn a fee from that redemption partner for essentially providing that customer. And by the way, when the customer arrives, they generally spend more than the amount, so there's an element of upsell as well. So the first element is a service fee or commission from the redemption partners, and we've contracted with over 200 of them. The second element then is that value of product isn't always spent, so there's often change on the end of a voucher, card or digital product. When that expires and it's unspent, and that drops through to revenue and gross profit. So we earn that. And then the third element, historically, as mentioned, is the interest income, because we hold a lot of customer client cash and we earn the interest income from that. So those are the three elements of the commercial model.
I'll just do an unashamed flag of our initiation in September, where we went into some detail on each of those lines as well. There was a question about growth. Question again. Turnover and profit trend was relatively flat, excluding the COVID dip. Suggesting you'll get back to those levels next year. Where's the growth coming beyond that? Is there going to be a lot more marketing? You're gaining market share? Is it new products? So medium-term growth, where's medium-term growth coming from?
So we see medium-term opportunities in two senses. One, the market is expected to grow. As I mentioned, the pre-COVID prediction was that there would be significant growth in the business side of it and overall growth for the market. And we want to be able to take our share of that. And the COVID couple of years has set that back, but delayed it rather than eliminated it. And indeed, in some respects, it may have increased it, because the focus on engagement with your employees, I think, has increased due to COVID rather than anything else. So we see that, and we want to be able to take our fair share of it. But we also see opportunity to be better at doing that, in the sense of improving our own internal processes, improving our effectiveness in our delivery for clients and customers, improving our own profitability within that. So there are two elements to it for us. There's the market, but then and taking our share of that, but then also improving our ability to take share, if you follow me. And I think the results we declared for the Q3 in the Q3 trading statement just show that when there's market there, when there's business to be done, we're able to take our share of it, and we want to improve our effectiveness in doing that. And so then, as the market grows, we would hope to keep taking our share, but actually take more of it as well.
I mean, the sort of related question, which is about diversification for other areas, but it sounds like you feel like the market growth plus doing what you do in it much better will give you that medium-term growth. It's not a case of diversifying into other areas, given you have so many touch points. That would be supplemental, more longer-term growth rather than medium-term.
Yeah, I agreed. I mean, more eloquently put than mine, Mark. But yes, yeah, we for other opportunities, we're not saying we're not going to be looking for them, and we certainly have ambitions in that direction. But you have to be confident in your own base ability first, and that's why we've been so focused on improving our core infrastructure, and you need to be able to be confident to build on that. And that's why, so medium term is what I said, but yeah, you're absolutely right. Where there's other opportunities, we do want to be able to pursue them, and by improving our core infrastructure, we've been able to get ourselves more confident to do just that.
Yeah, get your house in order before you try and take too much on.
Yeah.
What is the acquisition cost of customers across a business? Can you provide a breakdown of customers by age, male, female, geography, etc.?
Okay, let me take that. I mean, if we talk about Christmas savers first, we run a direct response TV and digital marketing campaign each winter to attract customers for the following Christmas. We've got a long-standing base of agents with very good retention levels. We've also got a base of direct customers, again with good retention levels, but we do recruit every year. The cost of acquisition has been increasing slightly over the last couple of years as direct response TV becomes less effective. So it's just over £50 a customer at the moment. But remember, those Christmas savers customers on average have a value of over £500. So that's on the Christmas saver side. On our corporate side, we're obviously dealing with two different sets of clients. We've got big corporate clients who go through tender processes, and so we have a business development team who partake in that. So we've got a people cost of having people dealing with big corporates, but the vast majority of those 40,000 clients are coming to us direct through either a self-serve portal, maybe from an initial telephone conversation, or direct through the website. So we look at the acquisition cost of our corporate accounts a little bit differently. It can be people based. It could be traffic through to the website to try and sort of work that through. But Christmas Savers, I guess, is the one where people generally are more interested. In terms of segmentation of the customer base, yes, we have it all. We haven't shared it all in the last couple of years, but we have a good breakdown of those customers in quite a lot of detail.
What are your medium expectations from the PayPoint deal?
So the PayPoint deal gives us access to their network, which is like 28,000 different outlets across the UK. We initially had some expectations that were well in excess of what was achieved, and I know we talking about this previously with investors, that we acknowledged that we were perhaps a little bit naive. We have learned that we need to do more work in terms of promoting the opportunity, making customers aware that the opportunity is there. So it's going to be a slightly slower burn. So I'm not going to give a number or give a target because we don't have one. We've had to reset our expectations in terms of learning our way into how do we promote it, how do we get people aware of it. There are positive signs, but they're very small volumes at this stage. The partnership is a good one, and I mentioned one of the things as we go forward, we want to do more with our partners, and we're looking at other opportunities with them, how we might provide other services for PayPoint, or access some of their other client base in other ways as well. So there's other strings to the bow, if you like, of the partnership that we're looking forward to working with them on. But the access to 28,000 outlets is fantastic. We just have to learn how to tap into it properly, and it's going to be a bit of a slow burn for us.
Ian, Tim, any final comments? We very much appreciated, and thank you for your time.
Thanks, Mark, and we're very grateful for the opportunity to talk to everybody today. I'll just reiterate what I said. We've been through a period of great transformation, restructuring the business, simplifying the business. It was always intended to transform it in a way that would make it fit for future. At the time we set out on this, nobody knew about COVID coming along and disrupting everybody in the way it did. And for us, COVID was a challenge, but it was also a bit of a proof point insofar as the business that we inherited would not have survived going into lockdown overnight back at the early part of 2020. We wouldn't be here talking about opportunities in the way we are if it hadn't been for the investment that had already been made in the year or two prior to that. That's just the reality of it. But more importantly, that just proves that what we're doing is effective, and we've continued to improve and solidify the base of the business. And we really are now looking forward with confidence around what the opportunities are. And the shift has definitely been away from fixing and more into growing, and then trying to push forward and continue to deliver in that fashion. And the results of the end of last year were very positive, and we want to just keep building on that. Okay. So again, thank you all. Thanks, Mark, and thanks everyone.